The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Bailey Lipschultz. We're kicking you off to the closing bell here in the U.S. Let's get a check on the markets right now. The NASDAQ 100 under some sharp selling pressure, being led lower by NVIDIA, big tech rotation, risk-off day after we got that economic report. We're also keeping an eye on the equal-weighted S&P 500. Scarlett, this wanted to go green at one point earlier in the day, but now down by about 0.25%. 10-year yield, call it pretty much unchanged on the day, as is the U.S. dollar. So really seeing the moves playing out in the equity market. The rest of the market playing pretty close to the chest.
So what it means is that we close out August with a sell-off in big tech, the same names that have powered the S&P 500 from record high to record high. As for what's next, investors brace for seasonal weakness, with September typically the weakest month of the year for stocks. Now, a court hearing on whether President Trump can fire Federal Reserve Governor Lisa Cook ends without a ruling and comes at a time when the central bank is weighing stubborn inflation with resilient consumer spending despite tariffs and a weakening job market. Here is what Ryan Wong of HSBC points out.
At the end of the day, 3% is still not the Fed's 2% target. If the Fed does cut rates by 25 basis points in September, it's still not going to necessarily mean a sequence of rate cuts.
Later in the program, we've got former Kansas City Fed President Esther here to share her perspective. And duty-free no more. The U.S. ends the de minimis exemption on parcels mailed from overseas, putting businesses and consumers on the hook for filling out customs forms and also paying tariffs.
And Scarlett, you mentioned we are ending August on a sour note and heading into what has historically been the worst month for the S&P 500. Yes, down about 0.7% on average over the last 20 years. Want to call out the fact that the worst month for the years between 2022 and 2024, all coming in September. So a brutal period heading into the final month of the third quarter.
All right, so let's kick things off with Victoria Fernandez. She is Chief Market Strategist at CrossMark Global Investments. And Victoria, you saw this setup that Bailey gave us with regards to this seasonal weakness in the month of September. You've noted for a variety of reasons there are a lot of risk-on tailwinds for this market right now. But do you think we're making too much of the seasonal weakness that has come up again and again in people's commentary?
Well, I think it's something you have to be aware of, right? Just like we see it in different parts of the year. We have the Santa Claus rally. We have other times of the year when there's certain things that move the market a particular way. So, yes, I think we have to pay attention to the fact that this is typically a very weak seasonal time for the markets, because you take that and then you have to add on top of it some of the extra uncertainties that we have right now, uncertainties around tariffs, what the path of the Fed is going to be. You know, are we going to see a difference now in earnings coming into the third quarter? Because we've had a lot of CEOs kind of prep us for perhaps not as strong a third quarter as many people anticipated. So it's part of the reason that you want to be a little bit cautious as we head in to the end of the second quarter and begin of the third.
Okay, so take that a bit further. What does being cautious mean in this kind of market environment? Do you lighten up on some of the big winners of the recent past quarters, or do you go full defensive?
I don't think you go full defensive, Scarlett, right? We're not sitting here saying we're about to head into a recession, but there are plenty of flags that are waving that say we're going to have a slowdown. We see it in the labor market. We've seen GDP expectations, even though they're not negative GDP expectations like we saw in the first quarter, they're still below potential. There's different weakening elements that we've seen in different parts of the market. Manufacturing is one of those as well. And so I think it tells you need to be, like I said, a little cautious. Have a little defense in your portfolio, but you're still invested in the market. You still have some of those sectors, your communication services, industrials, financials, those sectors that have been in uptrends and have that momentum behind them. You want to be in those sectors, but it does make sense to maybe trim some positions that have gotten a little bit overweight and have a little cash on the sidelines to where you can step in when you find some of these weaker sectors that perhaps start to form a bottom, like healthcare or energy, that you can add to.
And Victoria, all eyes are on the Fed right now as we go into a September rate decision where the market's pretty much baking in an 85% chance of a cut. How are you recommending clients position around that, just given kind of it seems like more of an insurance cut as opposed to the economic data right now, kind of setting the scene for an environment that needs rates to come lower?
But I think you're right. And the last part of your statement there, I think, is key, an environment that needs rate cuts. Right now, when we look, do we really need a rate cut? Probably not from an economic perspective. So that tells us that we could actually see a steeper yield curve, not just because the short end of the yield curve comes down, but because the longer end of the yield curve could move higher. We saw it at the end of last year. We could see some bond vigilantes come out and really push those yields higher. So we would look to position kind of for yield steepeners in the fixed income market, and then have some exposure, like we said, to some of those sectors that maybe would do better as yields move higher. So out of maybe some of the small caps that people thought were going to be really gaining some momentum with Fed cuts, we may only get one Fed cut this year. And if that's true, we'll see the equity market start to reprice that.
Yeah, Victoria, you kind of went right where I wanted to go. The market right now is pricing in 2 cuts by the end of the year. What if we do see Donald Trump be successful in pushing the Fed to bring rates lower much quicker than the market's expecting? And on the flip side, if these rate cuts don't actually play out, where are investors going to rotate to?
Yeah, well, you have to look at expectations that we're seeing right now. You're right that there are 2 priced in for this year, but a lot of it has to do with where the Fed comes out and says they think the neutral rate is going to be. We want to get those dot plots. We want to see what they're looking at. Are we looking at 4 rate cuts for the rest of this cycle? Are we looking at 5 or 6 rate cuts? I think you're looking at probably 3 or 4. So that tells us they'll probably be spaced out a little bit over time, and a 25 basis cut every few months probably would not move the needle tremendously in where you're positioned, at least on a tactical sense. So we would have some fixed income exposure and maybe lock in some of those higher rates that you see right now, so you can continue to have that. And again, we would be in some of those more momentum uptrend sectors, the ones that have shown that they continue to be in uptrends, even in volatility. We like financials. Those do really well in a steeper curve, and industrials should do well from some of the capex expensing and increase in manufacturing that we should see coming due to the bill that was passed during the reconciliation process.
So that sounds like a continued broadening of the equity market and not just this reliance on 7 big tech company names. Does that extend to small caps? You mentioned financials, and there are an awful lot of financials within the small cap space.
There are, and I think we have to be careful with small caps. We saw them have a little bit of a run up, but it didn't hold, right? They don't have that solid uptrend yet. They're not showing us that they can hold some of the gains that they have, and a lot of that has to do with the expectations around Fed cuts. So I would hold off a little bit on small caps. I want to see them prove themselves a little bit more to me. I'd rather miss a little bit of the upside and come in later when I know that they're going to continue to do well than get whipsawed on some of those. So I would hold off a little bit on small caps, focus on those other areas.
That's fair enough, given how many head fakes we've gotten in the past. Victoria, thank you so much. Victoria Fernandez, Chief Market Strategist at CrossMark Global Investments. Now, coming up on The Close, we'll take a closer look at today's PCE data, what it means for the Fed's upcoming rate decision in September with Esther George, former Kansas City Fed president.
Plus, PepsiCo boosting their stake in Celsius with a $585 million deal. We'll speak with the chairman and CEO, John Fieldy.
And TSA expects almost 3 million travelers to hit the skies today in advance of the Labor Day holiday. We'll discuss travel trends with Tara Minson, president of IntelleTravel. All that and more coming up. This is The Close on Bloomberg. So, sticky inflation, not enough to stave off consumer demand, at least in July. Spending climbed the most in 4 months, driven by income growth and goods purchases. Traders not really budging on their rate cut bets for September as the market digests the latest data. Let's bring in Simona Mocuta. She is chief economist at State Street Global Advisor. So, Simona, how does this set us up for the jobs report on Friday, now that we have the inflation picture, which is, things have stabilized, but we're nowhere near that 2% target?
No, we are not at target, but we, I think, are making progress in the areas that matter. And it's not just inflation that matter, I think, is perhaps the even bigger point here. We need to pay attention to the labor market, and there you see some troubling signs. So I think it's fine for the Fed to take another step, a careful step towards calibrating interest rates lower. We are not talking about any dramatic moves. And 25 basis point cut in September would not endanger progress towards inflation, in my opinion.
Okay, fair enough. We, of course, get the jobs report next Friday, but in the lead up to that, there's going to be the JOLTS data. There's also going to be ADP and Challenger jobs as well. These are private sources of data. How much more do you think people will fixate on that now that there's a new head of economic statistics at the BLS and perhaps some questions over how valid the data can be coming from the government?
Well, we've had issues with the quality of data, not just in the last 3 months. This has been an issue not just here in the US, but globally since COVID. A lot of challenges, the biggest one being the low response rate. So we've always used alternative data sources in conjunction with the public official releases. I think you want to look at every single piece of information that you have. And in my estimation, everything tells you the same sort of story, that there is a slow erosion here, and you don't want that erosion to become something more ominous. We had the big revisions in payrolls data. Again, that to me simply reinforced the story that labor demand is moderating. And you want to not let that get out of control, right? We are in a good place. Let's stay here. But I think in order to stay here, you need a little bit of response from policy.
And what does that response look like? Is it locking in a 25 basis point cut next month? And do you see that being the start of a trend of 3 or 4 in this cycle? Or how does that play out in your view?
So, despite everything that's gone on over the course of this year on the macro front, we've started the year calling for 3 cuts before the end of 2025, and we still hold to that view today. And again, this is a view of, gradual moderation lower. It's been 9 months now since the Fed last cut interest rates, essentially. We know we are not at target, but we think we get to the inflation target over the course of 2026. And the truth is, the Fed today or at the September meeting is not making policy for the, economy of September 2025, but rather the summer of 26. That's how long it takes for some of these actions to transmit.
But how much does tariffs impact that? Because we've been talking about the potential pressure on consumers for quite some time. And today's print, for all intents and purposes, looked pretty darn good to me.
The PCE data actually look good to me as well. Granted, you're on the surface not progressing towards where you want to be. But in fact, the print was a little bit better than I thought. I will say that we cannot simply focus on tariffs and inflation because there's a lot more to the U.S. inflation story than just tariffs, right? The piece that we forgot to talk about in recent months, and I'm surprised that we don't discuss this more, is what is happening to shelter inflation. That continues to moderate, and it's a huge component of the CPI and the PCE. And as long as I see ongoing disinflation and moderation there, I'm a little more willing to, live with an increase in goods inflation, which, yes, it's happening, but we are not, at 1% today. You're probably going to go a little bit higher. During COVID or immediately after COVID, we peaked at 12%. That we are not having a repeat of that. So it's not that it's not happening, but it's happening in the context of disinflationary pressures elsewhere. So all in all, the impact is muted.
And I'm so glad you bring that up, the thing that we're ignoring, shelter inflation. What you see there, if you can break it down for us, is that through rentals or is it through owner-occupied residences? And I ask because I wonder how sustainable it is.
It seems pretty broad to me. I mean, as with everything, I try to look at as many indicators as I can get my hands on. And I see it in home prices moderating at the margin. You see it in the Zillow rental data for the national aggregate as a whole. You're seeing it in more dramatically in some of the experiential series, like the new tenant rent from the Cleveland Fed. I don't take that as face value. It shows a big decline in the last print, but I take it as a directional indicator. And so it seems that even in the housing market, there is a bit of a balancing out of supply and demand and a little bit of price moderation that can be sustained, in my view.
Simona, thank you so much for joining us today. Simona Mocuta is chief economist over at State Street Global Advisors. Coming up, we turn to company news because PepsiCo boosting its stake in Celsius with a $585 million investment. Chairman and CEO of Celsius, John Fieldly, joins us next. This is The Close. PepsiCo turning up the heat on its Celsius investment, upping its stake in the energy drink maker in a $585 million deal. Pepsi's stake in Celsius now 11%, while Celsius agrees to acquire Pepsi's Rockstar energy brand in the U.S. and Canada as part of this transaction. Celsius shares climbing to a 14-month high. Now, joining us live for more on this deal is Celsius Chairman and CEO John Fieldly. John, you've been quoted as saying this deal positions Celsius as their strategic energy drink captain for Pepsi in the U.S. What does that mean? What does that actually look like in practice?
Yeah, no, it's an exciting opportunity on this transaction. And when you look at the energy drink category, it continues to evolve. It's one of the fastest growing categories. And being the lead energy drink captain for Celsius, we're able to really control our portfolio, which now includes 3 brands, controlling planograms. When you look at your routes to market and your different channels at retail, it's really important that you have the right portfolio, the right products available for that consumer segment. And that could be at divisional level, regional, and market specific. So this allows us to really maximize the overall value of the Celsius Holdings portfolio, and today, which includes Celsius, Alani, and Rockstar, which will all be under one distributor.
Okay, so let's talk about that. You no longer have to split everything up and use 250 independent distributors. Tell us about the portfolio that you've amassed here and how you've carved up the energy drink market. As you mentioned, you have Alani Nu, which Celsius recently purchased. You also have Rockstar, which has been in the Pepsi portfolio. And of course, you have Celsius itself. Which part of the market does each go after?
Yeah, so by the way, there's a modern energy taking place. Fitness, lifestyle is one of the fastest growing trends. So our Celsius portfolio is about Celsius Live Fit. We inspire you inside the gym and outside the gym to accomplish your goals. It comes in great flavors, refreshing flavors. We have carbonated and non-carbonated offerings. And then Alani Nu portfolio is new. We just put up a record quarter in the second quarter of this year. It's our first quarter of integration. It's gone extremely well. That brand really focuses on females. It's a female-focused lifestyle brand for today's health-minded consumer. It's inviting and approachable. It comes with great flavors. What's fascinating is it's one of the fastest growing functional beverages in the energy category this year. It's been phenomenal, and it's going to continue to grow and scale. And females have been coming into the category more than ever before. And then Rockstar's been around a while, but there's a huge opportunity. Over 50% of the category is really traditional energy. And when you look at our portfolio yesterday, was really Celsius and Alani, really goes after that modern energy. Rockstar allows us to go over that 50% with traditional energy, going after that 25 to 35-year-old male. And we're really excited about it. Mainly, the largest percentage of sales are in the Pac Northwest, but there's opportunities to optimize the portfolio as category captain across the country through PepsiCo.
And John, as you look to grow sales, is that taking market share from competitors? As you mentioned, is it just strictly expanding the total addressable market? What's really the strategy there?
Well, what's really fascinating in the energy category, it's one of the fastest growing segments in beverage. New consumers are coming in, increased consumption habits. We're seeing share taken from cold coffee, like cold brews is an area where the energy drinks are capturing more consumers. And people need more pickups, and they want better for you offerings. So we've been actually incremental with the Celsius and Alani portfolio, bringing in new female shoppers and also new health-minded consumers into the category. So really well positioned, and this really Rockstar opportunity rounds out our portfolio. And the other thing, in order to compete at the highest level, one of the fastest growing categories, which is highly competitive, having a multi-brand approach offers you additional enhanced strategies with pricing promotional strategies at retail to make you that much more competitive.
And John, when I look at people who are buying energy drinks, it's normally when I'm filling up my car and getting gas. Where are you seeing consumers really buying these energy drinks, and where are you seeing that potential growth?
Well, what's interesting, if you go back, energy drinks have always been a need state. I need an energy drink for a specific occasion to accomplish specific tasks, mainly in convenience. It still represents a large portion of the energy drink sales today, but what we're seeing is large format, groceries, and mass are becoming a larger piece of the pie. And what that means is that people are buying energy drinks in larger packs. It's becoming part of the pantry. And once you're part of the pantry, you're part of a daily lifestyle and a daily routine. And that's where we're seeing this category continue to grow.
You say it's part of the daily lifestyle, and we certainly see that, but there are some health concerns, especially with regard to the level of caffeine. You look at one can of Celsius, and it's about at least 200 milligrams of caffeine. You compare that with a can of Pepsi, about 35 milligrams, a cup of coffee, 50 milligrams. Young adults are clearly a key demographic for these drinks, but anxiety and cardiac issues are a side effect of caffeine, and this generation of young people is prone to a lot of anxiety. What are you doing to address that and get ahead of it?
Yeah, I mean, moderation of any products is very critical. We recommend no more than 2 a day. But I will say, when you look at your average caffeine in coffee, your average coffee house, which is right around the corner of pretty much all of us, is well north of the caffeine content in our products. So those coffees, those tall coffees, those large coffees that are there, and the cold brews that are out there are actually a lot more caffeinated than your average Celsius, Alani, or Rockstar.
3 years ago, we saw that Pepsi bought an 8.5% stake in Celsius for $550 million. Now it's increasing that stake to 11%. So it's only natural that there's talk of an eventual buyout of Pepsi, by Pepsi of Celsius. My question to you is, why is maintaining control of Celsius important to you right now?
Yeah, I mean, this investment from Pepsi really solidifies our strategic alignment, brings in an additional strategic investor, also adds additional board member for PepsiCo, which strategically aligns this organization at the highest level. So, we're publicly traded, so you'll have to ask Pepsi what other additional investments they're looking to make. But at this time, we're excited about the transaction right now. It aligns us on a financial basis. It aligns us strategically. It aligns us commercially with the category captain over the energy portfolio of Celsius Holdings within Pepsi. And it also further enhances our capabilities with a total portfolio approach.
All right, good stuff. Celsius Chairman and CEO John Fieldly, thank you so much for joining us today.
Thank you. Cheers.
Cheers.
Have a great weekend.
All right, fantastic. I look at the cans and the can of a Celsius looks pretty appealing. It's clean compared to Monster, which is, screaming at you.
Well, I think the thing that's interesting is isn't this all marketing? And so them being
Yes.
the captain of the brands is that's really what you're selling. And that's kind of why it's interesting to see the different types of cans and where they're selling it, who's actually buying it.
Or the fact that there's a female-focused energy drink. That kind of took me by surprise. I didn't know about that.
Would you buy it?
I mean, I don't drink that. I go with tea. Well, what's your caffeine of choice?
I'm a big Americano fan.
I'm a big Americano fan.
Which, again, to his point, caffeine, I definitely consume too much, but in the clean type.
Are you getting tall coffees like he's referencing?
No, not really. Normally the small guy.
All right, well, maybe we'll get you hooked on big, tall cans. Coming up, we've got former Kansas City Fed President Esther George joining us live to dig deeper into the Trump-Cook saga and what investors can expect out of the Fed as we approach that September meeting. This is The Close on Bloomberg. It is just about 3:30 p.m. in New York. This is the Countdown to the Close. I'm Scarlett Fu.
And I'm Bailey Lipschultz.
And of course, given that it's the Friday before a long weekend, the last bit of summer, there's quite a bit of news flow, surprisingly.
A lot of news. We've got economic data, consumer holding up strong, but inflation coming in hotter than people expected. We have Nvidia down 3% a couple days after earnings print.
Yeah. And it makes you think about how we're set up for September, which tends to be a seasonally weak period for stocks. A lot of people talking about that, given that there are so many different catalysts recently for the month of August.
And there's a lot of uncertainty, obviously, around what the economy is showing. We do have a key Fed decision next month. But as you mentioned, you have a Fed potentially cutting in a month that is seasonally weak, with investors maybe taking some chips off the table?
Yeah, all good points. So, and in addition to that, you have some drama unfolding as well at the Federal Reserve. And here's the latest between that saga, the ongoing saga between President Trump and Federal Reserve Governor Lisa Cook. An emergency court hearing on whether the president has proper cause to fire her did end without a ruling. So this power struggle rattling global financial markets and raising questions about how the White House pressure might weigh on policymakers. I'm pleased to say that we are now joined live by former Kansas City Fed President Esther George. Esther, thank you so much for joining us today. From where you sit as a former regional Fed president, do you see this as a legal dispute between President Trump and Lisa Cook, the private citizen who applied for mortgages before she was named to the Fed board? Or is this more a dispute between President Trump and the Federal Reserve as an institution?
Yeah, well, good afternoon. I think clearly this is another step in an ongoing pressure and attack on the institution in terms of the authorities of the executive branch relative to the Federal Reserve. And so, however this plays out in terms of the details of the specific case that's been brought forward, I think what's at stake here for the American public is really to understand who will be influential in the decisions that the Federal Reserve makes in the years to come.
And personnel determines policy, as we've heard so many times from this administration. And the concern here is that the president will next target the appointments or the renewal of appointments of regional Fed presidents in February of next year. How concerned are you about that?
Well, I think it would be very concerning, and I'll tell you why, Scarlett. If you think about the origins of this institution, they were firmly anchored in making sure that political pressure would be as limited as possible in terms of the critical decisions that the Federal Open Market Committee has to make for the long run. And so the idea that you would structure the institution in a way that would protect that long run view and not drive it in the direction of short run decisions was critical. And it proved to be relatively durable over the last 100 plus years. So that's what's at stake, I think, as we look at how this unfolds, is how will the decision-making process of this institution play out and really take a more long-term focus as opposed to shorter-term interest.
And Esther, how much of a distraction is this for Fed officials? Again, we do have a closely watched Fed decision next month, given the back and forth with President Donald Trump.
Yeah, so there is a lot of noise going on, and I think it's most unfortunate because there is already enough uncertainty that's coming at the decision they have to make relative to the performance of the economy. This is a time as the economy is showing shifts, whether it's from policy, whether it's from cyclical factors, that you really want the committee to be able to focus on the debates they will be having at their meeting in September. And I suspect they are doing their best to spend their time focused on those key issues so that when they come to the table in a few weeks, they can really make those decisions in a manner that serves the public, serves the economy longer term.
And with that in mind, how does cutting interest rates next month, again, the market's pricing in an 85% chance, we have inflation still hotter than people were expecting. We have a jobs market that is strong and consumer spending showing no signs of slowing down. So what does that signal if and when we do get a Fed cut next month?
Well, I think that's at the center of the debate. And we've heard the narrative that has come out of the committee talking about the balance of risk, where they see upside to inflation, where they see downside potentially to the jobs market. And of course, next week, we will get another piece of what I call the economic puzzle to see how is the job market faring as they come into this meeting. So the economy looks to be performing pretty good. The decision is, do they see something ahead that suggests the economy will slow in a way, the job market will be damaged in a way that requires them to ease policy at a time when inflation is holding in there pretty strong?
You point out the jobs report that's coming out next week. We know that the president fired the head of economic statistics over at BLS, and we don't know whether that will affect the quality of the data immediately or in the long term. But it does open this door to doubt creeping in over the quality of that data. If you were a sitting Fed president still, how would you broaden out your reliance on other data?
Well, as a regional Fed president, Scarlett, you know that there were a lot of confirming sources of data. So obviously you do rely on official statistics to guide your understanding of the economy. But when you serve a regional area, as I did, some 7 states, you spend a lot of time talking to those that are working in the economy. How are they making decisions 6 months ahead, 12 months ahead? Which give you tremendous insights to things like hiring, to things like pricing for their products. So that is a key component. It has always been a key component. And I think at a time when you're beginning to see a transition around thinking about the stance of policy, it becomes ever more important for this committee to lean into those anecdotal as well as their official statistics.
Right, the on-the-ground research that keeps you close by to what your region is telling you. If the president successfully remakes the Fed to reflect his priorities, which is lower rates and a lower rate cycle overall. What would that mean for debates on things like the neutral rate, the 2% inflation target, the framework overall? Do they just become academic discussions and not as relevant to the actual policymaking?
So, Scarlett, I don't know how those conversations will unfold, obviously, but I think the point you make is this is an institution, as with many institutions, that we want the public to trust. We want the public to believe that the decisions are made in the interest of long-run economic stability for this country, that growth can be promoted. And if people begin to see cracks in the ability to trust an institution making decisions on that basis, that can be problematic. So we will continue to hope that people that come into these roles will carry out that tradition, carry out that very important role of focusing on what serves the long-term interest of this country.
Esther, we really appreciate your joining us today. Esther George is a former Kansas City Fed president. Thank you so much. Fascinating conversation. I loved how opinionated she was. She's very firm in her conviction here.
No, very firm, and there's so much uncertainty, and we're living really headline by headline, social media post by social media post. So there's so much uncertainty, again, around the independence of the Fed and what this actually will look like and how long it's going to take.
Right. That's a good point, because it might not be something you see immediately, but over time it becomes normalized and it becomes something where perhaps we took the independence of the Fed for granted.
Yeah, I feel like we've used the word unprecedented far too much this year.
Absolutely. All right. Coming up, Dell's decline. We're looking at shares falling after the tech company reported earnings yesterday. We're going to take a closer look at this maker of AI servers next in our Stock of the Hour. This is The Close on Bloomberg.
Time now for today's Stock of the Hour. Dell shares down more than 9% after the tech company reported fewer sales of AI servers than in the previous quarter. Along with that, profit margins missed expectations. Joining us now to discuss that is Bloomberg's Andrew Pollack. Andrew, want to start with that headline beat and raise, but as I mentioned, the servers and margins falling short. Why are we seeing the stock down so much?
I think there's a couple of factors. Like you mentioned, the amount of servers that they shipped was fewer than the previous quarter. I think that concerned people, but also combined with results from NVIDIA and Marvell, I think investors are a little worried that the AI boom may be softening. And so that was part of the concern, in addition to, like you said, the profit margin. Selling those servers, while it generates a lot of revenue, they don't make as much money because they're very expensive to build. So I think that's kind of what's going on here. People are a little worried that Dell, which has been seen as really a beneficiary of the AI boom, it may be slowing for them a little.
Gotcha. There, to that point about the profitability, the margins, the COO did answer a lot of questions from analysts on the call about that. And apparently there are some expenses tied to that really eroded the margin. Are those one-time items, or is this something that investors need to get accustomed to?
Well, that's what COO Jeff Clark said, that they were one-time items. Now, today is Dell's worst day since the President Trump first announced his tariffs in April. And Dell has had to manage, like the other hardware companies, the tariffs. And so from time to time, I think their supply chain, it affects their supply chain and affects profitability. Now, they're very confident that they can handle this over the second half of the year. But again, I think these are concerns that investors have, and that's showing up in the stock today.
And Andrew, as we look at the entire ecosystem is under pressure today, obviously it's a risk-off tape, but when you look at kind of the commentary that we saw, how does the outlook for, as you mentioned, the rest of this year, but even as we get into 2026, how is that shaping up and what are we hearing from management?
I think for Dell particularly, it's still very positive. I mean, they, as you mentioned, they raised their forecast on how much they're going to ship in AI servers to 20 billion from 15 billion. They have a very close relationship with NVIDIA, the world's most valuable company and the maker of the powerful chips that go into these servers. So going forward, I think the outlook is good for them. At least they're very confident it is.
So it seems to be a case of profitability concerns rather than demand per se. I'm wondering if there continues to be demand and Dell can't fulfill it, certainly without sacrificing some margin. Who is its biggest competitor in providing these AI servers?
Supermicro is one of the competitors. Hewlett-Packard Enterprise is another competitor. But really, I think that yes, the profitability is an issue, but it's an issue for all the companies that make these servers, again, because the components that go into them are so expensive. So as the analysts say, it generates a lot of revenue, but it doesn't really push up your profit very much.
All right, good stuff. Bloomberg News' Andrew Pollack. He is our senior tech editor joining us from San Francisco. Thank you so much. Coming up, we take you to the closing bell. Mark Luschini, chief investment strategist at Janney Montgomery Scott, will be joining us next on this Friday before Labor Day. You have an S&P 500 down 2/3%, being dragged lower by the big tech names. The Russell 2000 holding up a little bit better here, and that is only off 0.75%. This is the close on Bloomberg. Welcome back to The Close. Just a few minutes until the closing bells. I'm Scarlett Fu.
And I'm Bailey Lipschultz. We are ending August, limping in to Labor Day weekend. As you can see, big tech sell-off. I'll call it big, but lowercase b on that big. NASDAQ 100 down 1.25%, being dragged down by NVIDIA, accounting for 82 points of that. Want to call out the fact that Google, though, is trading higher, as is Pepsi & Co. We're seeing the S&P 500 equal weight under a touch of pressure, but really outperforming that. 10-year yield essentially flat, as is the Bloomberg dollar. Scarlett, it feels like we'd been waiting for equities to catch up to at least some form of a risk-off move. Volumes are lower. I will acknowledge that. It is a sleepy summer Friday, but finally seeing a bit of a pullback.
Yeah, I'm looking at a drop of 29% in volume from the typical 3-month average for the S&P 500. So it makes sense given where we're at. A lot of talk about this idea that there's some September seasonal weakness that people need to be positioning for. I don't know if I buy it or not.
I don't know either. I just want to call out, we were at an all-time high. The NASDAQ's up 5 months in a row, so a lot of gains on there for equity investors. But with that in mind, for more market analysis, we welcome Mark Luschini, the chief investment strategist at Janney Montgomery Scott. Mark, we're talking about a strong market running into what is a seasonally weak period. We got some economic data. What are you keeping an eye on, and what are we should we be expecting on the other side of Labor Day?
Well, the jobs report, next Friday is going to be key. Obviously, it's a setup for what the Federal Reserve is likely to do, a couple of weeks following. We want to know whether what we saw from last month's report was anomalous or the beginning of something that is deleterious relative to its impact on economic activity. So certainly have all eyes on that. But having said that, the market's obviously misbehaving a little bit today. Clearly, a defensive bias to the sector returns with the historical leaders, tech, communication services, even consumer discretionary industrials being the laggards today. But that's not true for the week overall. We're kind of flattish for the S&P 500. And anytime you get up to kind of a round number, particularly something like 6,500 on the S&P, with a valuation at 22 times forward estimates as not being inexpensive, you're right for an air pocket. So no surprise that we see some weakness here at the unofficial end of summer. And I think, again, this setup, given the seasonality factor that you had already talked about, that September's notoriously a weak month for the stock market, I would expect that we'd see perhaps some volatility. But all said and done, we're still constructive on the equity market as we go toward year end.
Yeah, Mark, we were kind of joking on our desk that sometimes you see the market pull back just because. And that was really when you hit an all-time high, investors are looking for a reason to take some chips off the table. Are we going into a market with all eyes on that jobs data where we're going to still be in kind of a holding pattern on the other side of Labor Day? Or what are you expecting, call it Tuesday, Wednesday, Thursday as well?
Well, there's no lack of data coming out next week. Set up even before the BLS report comes out on Friday is the JOLTS report. That certainly got my interest as it relates to reports on job openings and the vacancy rate, and that can have some impact on the market overall, perhaps being somewhat prescient in nature relative to what we might likely see on Friday. But otherwise, the market is right now baking in, close to a 90% chance that we're going to get a cut in mid-September at the FOMC meeting, and over 2 cuts between now and year end. And of course, Governor Waller and even Governor Daley did nothing to dissuade market participants from thinking that a rate cut is all but assured at this juncture, given their comments here over the last 24 hours or so. So, anything that would cause a disappointment on that rate cut front could cause, like I said, some indigestion that notoriously we'd see in the month of September. If anything, perhaps an excuse just to take a little money off the table, off of the valuations, and maybe even sell a little bit more of what we've seen here, which is some pressure on the tech space relative to a couple of these companies reporting good news overall, but just failing to meet the full-blown expectations of the market.
You talk about the rate cut expectations. That's certainly reflected in the yield curve. 2-year yields down 2 basis points, and we have this continued curve steepening. It's kind of what everyone's saying they're expecting. What does a continuously steepening yield curve mean for equities, for cyclical sectors versus growthy sectors like tech?
Well, I think, first of all, it's good for cyclical sectors because if the steepening is a reason to believe that the market is baking in prospects of sturdy, if not even better growth ahead out in the latter quarter of 2025 and into 2026. We know the market tends to live in the future, that cyclicals would be behaving pretty well in that environment, taking the evidence from a steeper curve, which is anticipating more rapid growth, perhaps a bout of inflation remaining somewhat sticky. As we know, we got the PCE report today, the core PCE well above the 2% handle that the Fed is targeting. So, we see financials acting real well in this environment, certainly. And I don't think it's necessarily an encumberment on the tech sector. So as long as they continue to deliver, the results that we've been accustomed to, they should be among the leaders anyway. But I think we've also seen a boost in the industrials as a consequence of not only the One Big Beautiful Bill Act and the prospects for infrastructure investment, reshoring, onshoring. But I think overall, there is good news, if you will, if one is looking at the yield curve steepening as evidence of what's likely to come.
Mark, how are people positioned right now when it comes to the rotation out of the big cap tech names and into other sectors like industrials, like financials? Would you say that we're, 2/3 of the way through that rotation, or are we still at the beginning?
Well, if you look at the performance, the significant outperformance, if you will, of the tech and tech-adjacent companies, it would suggest that any rotation, which we've been teased by many times over the last couple of years, is in its early innings. I'm not suggesting that we necessarily see a rotation that is persistent in the defensive sectors. Today's leadership, consumer staples, even the beleaguered healthcare sector is among the leaders today, but rather to see that broadening out, as you mentioned, into financials, industrials, other corners of the market that also represent, in terms of their weighting in the S&P 500, a sizable enough amount that in the aggregate can still prop up the overall cap-weighted index, even if tech is weighing on it. And we've seen some recent outperformance by the equal-weighted S&P 500. I note that you posted that before our conversation got started. And it's up about 3.5% or so since August 8th. Against the less than 2% return for the cap-weighted S&P 500. And like I said, I think that may be an early inning situation in which some of the broadening of the market would actually be viewed very healthily, if you will, by investors.
All right, Mark, really appreciate your joining us and giving us your take. Mark Luschini is Chief Investment Strategist at Janney Montgomery Scott. Have a great long weekend. And of course, we are headed towards a close. I like the way you put it earlier, where we're limping to the end of August.
It's slow. It's a slow summer Friday, but if you look at the red on the screen, we are really seeing all of the momentum that we saw earlier in the week kind of fizzling out.
Yeah, it's a really good way of putting it. NVIDIA was kind of the high point in terms of what everyone was looking ahead to, thinking it would be a big catalyst. But because it had powered the big tech rally out of the April 8th low, it had to deliver on all cylinders, and it didn't quite get there.
Well, the interesting thing was they report earnings. We see the immediate kind of knee-jerk reaction, selling pressure. The stock trades higher and kind of flip-flops between red and the green yesterday. And today is the day that investors are deciding, maybe I don't want the exposure to these big tech winners when you're talking about the biggest company in the world. Again, going into a seasonally weak month.
All right, so with that in mind, let's bring in Jess Menton of Bloomberg News and Jonathan Levin, who is down in Miami, to parse through the most crucial moments of this trading day. Jess, what are you paying attention to?
Well, volume for one thing, just since we're about to go into a holiday weekend. So when you look at AVAT being down compared with the last 30 days, basically volumes down around 20% at this point. And so typically, the Stock Traders Almanac was talking about, you shouldn't be surprised to see that Friday leading into Labor Day weekend where investors typically take profits. And usually the S&P 500 does average decline about 10 basis points going over the last 2 decades on a day like today.
And John, you are down in Miami. What are you seeing in this market that maybe those of us stuck in New York in the New York mindset are missing?
Well, I don't know if it's a Miami thing, but clearly a change of sentiment about the AI story that has powered us for so long. And, you know, it's just this change of mood. People talk about it as a September thing. But remember, NVIDIA is the unofficial end of earnings season. And now what do we have to look forward to? This Fed decision. And there's a lot of uncertainty heading into that third week of September, starting with the jobs number that we're going to get next week.
Yeah, all I know is that when I look at my own commuting into the office, it was an empty bus and an empty subway. So as Jess mentioned, low trading volume, but we are ending August in the red. But keep in mind, guys, this is another month in the green, all things considered, for both the S&P 500 and NASDAQ 100 on a pretty solid tear.
And I'm so glad you mentioned that. All right, so even though there's a lot of red here on the screen for equities, the Dow, you can see they're losing about 0.2%. The S&P 500 retreating from a record high because it did close at an all-time high yesterday, now down 0.6%, and the Nasdaq losing more than 1%, really reflecting the weight of those big cap tech names. And we should mention as well, the Russell 2000 losing ground by 0.5%, so holding up a little bit better than the S&P 500.
Yeah, and just looking at the areas of the market that outperformed today, we're talking about safety net companies, healthcare, consumer staples, real estate outperforming again in a day that tech and consumer discretionary as well as industrials underselling pressure. So you are seeing at some marginal level a rotation back into those safer investments, the value stocks and those dividend payers.
All right, and within the S&P 500, 285 stocks gaining, 216 declining. So, Jess, you're looking at gainers. You should have had plenty to choose from.
I know. So looking today, though, top the leaderboard for the S&P 500, it's Autodesk. ADSK is the ticker. Software company jumping on a strong earnings report. Also raised its full-year forecast. If you look at that stock up a little over 9%. So it was its best day since April 9th there. And then from the sell side, Citi was saying it has a price target of around $376. If you look where it closed today, though, actually around $314 there. So still a way to go, but that company obviously and the firm more optimistic on that stock. And then, of course, U.S. listed shares of BABA, that being more of a bright spot, too. So if you look at that stock, obviously, when it came to U.S. trading and where it's been up almost 13%. So that was its best day since March of 2023 there. So if you looked at what was happening, it saw a surge in revenue really tied to what was happening with its China boom with AI. So that helped offset a surprise when it came to a decline in profit. And then, of course, you and I and Scarlett were talking about Petco yesterday. Woof. So obviously, Woof is the ticker symbol on this. So soaring almost 24%. So it's best day since July 22nd. But we were talking with Bailey about this yesterday when he was pointing out if you look at the short interest and the percentage of float being above 20% going into that earnings report. So that's a big key there, but its third quarter guidance beat expectation. Also had a brighter 2026 outlook, but again, still trading around $3 a share when it was trading around $30 in 2021, guys.
Yeah, big move for Scarlett. My favorite ticker, as you mentioned, Woof. Jonathan, I just want to ask, what is on your radar, and do you have any cool tickers?
Yeah, well, I think we got to start talking about NVIDIA, right? Because this was the big turn and the thing that really drove the market today, closing down 3.3%. It basically looks like, post-earnings hangover. Again, to recap, the midweek earnings basically told us that this is a stock that is moving from extraordinary growth to great growth, but that step change in enthusiasm is resonating in the market. Should also point out that we have this Wall Street Journal report that Alibaba is developing a new chip to compete domestically in China with NVIDIA's H20. I don't know if that's playing into the sentiment here. Moving on, got to call out Dell, down 8.9% as of the end of the day. It had that earnings report. Again, you're looking at a stock that's declining after the company booked fewer sales of AI servers than the previous quarter. Dell booked $5.6 billion of AI server orders in fiscal 2Q, according to Bloomberg's Dina Bass. That's down from $12.1 billion in the previous period. And then lastly, I got to go on to cosmetics. That's my specialty, as you guys know. Ulta Beauty down 7.1% on the day. The shares are falling. This was a little bit of a head scratcher. The initial reaction to the earnings report was different, but the shares end up falling on the day on a company warning of a pullback by consumers.
Huh.
The interim CFO saying that the cosmetics retailers' comparable sales would be flat to low single digits in the second half of the fiscal year, although it did raise its full year outlook, but that apparently was not enough.
Okay, that
investors.
confuses me because I thought cosmetics was supposed to be some kind of a recession indicator, and they're raising their full year outlook, but then saying that people are pulling back. I guess we'll have to unpack that a little bit. In terms of the yield space, let's go there. Steepening of the yield curve is what we saw. You could see that there was some declines at the short end of the yield curve. The 2-year yield goes down about 1 basis point. We did get data on consumer spending, personal income, as well as consumer confidence and PCE. Stubborn inflation. People are spending, even though there's concerns about tariffs and a weakening labor market. It all is kind of part of the drumbeat to the big jobs report next Friday. And you could see yields moving higher at the longer end of the yield curve, the 10-year up 2 basis points, the 30-year up 5 basis points.
And that's what's going on in the markets, guys. But want to have a little bit of fun on a, call it, Friday going into Labor Day, not call it Friday, actual Friday going to Labor Day. Looking at the story that hit yesterday, Amtrak debuting a new high-speed Acela train after years of delays. I'm talking about this because I'm someone who yesterday had a delayed commute into the office and going home. It took me 2 hours each way when it should be 1 hour and 10. So it seems like after a long time coming, this is going to make it easier to connect DC, New York, and Boston. $2.35 billion project, guys.
It's pretty unreal, especially when you think about how Acela trains are capable of going much faster than they currently are able to because of some tight turns in the Boston area. I'm not someone who makes this trip regularly. I know Michael McKee does it quite a bit, and I think anyone who needs to go along the Northeast corridor is looking forward to high-speed trains. Jonathan Levin, you are in Florida, and you guys don't rely on Amtrak there, do you?
No, but we do have the Bright Line. One thing that I'll tell you about these things. These are great to have. They're good for the community. But at the end of the day, it's all about changing the culture. That's certainly been the experience here in South Florida. I mean, you build these things, but is the price point right where people are going to ride them on a regular basis? Are people actually willing to get out of their cars? I can tell you here in the Sun Belt, that's been the real discussion, not can you actually bring the product to market.
Yeah, as someone who's from Los Angeles, you go from the opposite coast where everyone's driving, everyone's sitting in traffic, whereas here in the Northeast, everyone gets on a train. Scarlett, I don't know about you, but it seems like we've got the MTA, we've got NJ Transit, we've got Metro North. What do you ride?
I ride the Metro North, I ride the subway, and actually the most reliable way to get anywhere in this city is to walk, even if it's raining. So, Jess, are you a commuter?
So I either walk to actually like to take the bus more because I found that in recent years it's actually been a lot easier for me personally. So I actually prefer it, and there's fewer people, and it's quicker for me to get to work. So it works for me.
Love it, love it. I mean, some people might take the Acela to get to weddings, this summer, or maybe not even this summer, because apparently this is a new thing where people don't want to host their weddings in the summer because it's too hot, there's extreme weather, there's rain. So they're moving more and more to holding weddings in the fall or in the spring to avoid the discomfort of super hot weddings.
Yeah, as someone who got married in June, it was almost 100 degrees.
Was it?
But we took our photos at the end of the day inside because we had to escape the heat. But I only can imagine, Jonathan, that heat is even hotter in the summer down in Florida.
Oh, yeah, totally. Well, little known story. I got married in Mexico. My wife is Mexican. We got married in the desert of Northwest Mexico. So I don't know what these people are complaining about. Come on.
Jess, would you go to a wedding in a hot area in the middle of summer?
Well, I'm from Texas, so I've been to tons of weddings.
It's always hot.
And I can confirm it's pretty hot out there, but I gotta say it's really beautiful. They'll have the sunset there, and then usually there's an indoors in case it rains, something like that. The band's inside, the refreshment, so it works.
Yeah, a lot of the wedding planners have figured out ways to work around it, right? They have misters, they have like the cooling area, the patio. It's all like kind of planned out. As long as you pay for it.
Everything costs some money. Hey, New Jersey, I will say, is the best when it comes to cocktail hours and alternative options, indoor, outdoors, and in the fall, especially when it's foliage.
Okay, there's a thumbs up for New Jersey from Bailey. All right, that does it for us this hour. I want to thank our Jess Menton and Jonathan Levin for joining us as we close out this Closing Bell segment. Coming up on the close, we're going to wrap up the last trading day of the week and the month with Jim Bianco. He is president at Bianco Research. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Bailey Lipschultz.
And if you look at what happened in markets today, a pullback from record highs for the S&P 500, a pullback in tech stocks overall. And that's why the Nasdaq 100 down 1.2%. A clear contrast, Bailey, to the minimal move in the S&P 500 equal weighted index.
Yeah, we're seeing that kind of trade happening in real time where you're seeing investors rotating out of big tech and pushing their money into some of those safer bets as it broadens away from NVIDIA. But want to now take a look at some of the day's biggest movers. We've got some winners, we've got some losers. Ulta down 7%. This comes after cooling consumer spending. We were just talking about it with Jonathan. A lot of kind of mixed messaging, if you will, Scarlett, in terms of kind of setting guidance that analysts saying could prove conservative. Also, when you're talking about a stock like Ulta, you're talking about one that, in my opinion, could have been priced to perfection. We saw a big run up in the last few months. A firm up 11%. This is so key to me because we are expecting Klarna's IPO next week, and then Caterpillar down more than 3.6%. This comes after they're calling out tariffs impacting the business, so certainly an area to keep an eye on.
So Klarna's IPO next week. Thank you for bringing that up.
Launching it.
Launching it.
Not
okay.
pricing.
So when would it price?
The following week.
Okay, so in 2 weeks, that's going to be a big catalyst for the market here.
That'll be a big one. We are expecting a busy period for the IPO market on the other side of Labor Day.
All right, so just add that to the list of things to watch for in September. Our top story this hour is we closed out August with a sell-off in big tech, the same names that have powered the S&P 500 from record high to record high. As for what's next, investors bracing for some seasonal weakness. September is typically the weakest month of the year for stocks. We'll get into that in just a moment. In the meantime, let's kick things off with Factor Friday with Chris Cain of Bloomberg Intelligence. So, Chris, get us started here in terms of what you're paying attention to, because the S&P, as we mentioned, closed at a record high yesterday, came back a little bit from that today. What does the data say to expect from the markets after an all-time high is set?
Yeah, Scarlett, like you said, we just had an all-time high yesterday. You know, it's quick to forget because today was a bit of a bad day. But, you know, to not bury the lead, the clear thing that the data shows is higher returns and lower risk after an all-time high. And that's a little bit counterintuitive, but quantitatively is true. Higher returns are basically another way of just saying that the market itself has momentum. I think most people know that. The more striking thing is the lower volatility. And this is very quantitatively consistent. So we looked at all months since 1950. After an all-time high, the forward 6 and 12 months had an annualized volatility of about 11%. When you use all the days, it's about 14%, the S&P 500. So it's a significant reduction in volatility after an all-time high. I think a lot of people would be surprised about that because it's kind of counterintuitive, but it is true.
Yeah, that's interesting stuff focused on the U.S. I want to ask you, how has the value factor worked in Europe? Is it better than it's been doing here in the U.S.?
You know, I think this is a totally, underreported story. I mean, value is absolutely rocking in Europe. Factors generally are working very well in Europe, much better than the United States. When you look at the Eurostock 600, breaking them up into 5, groups, the cheap group, is up about 20% over the last year. The expensive group is only up about 5%. You compare that with the United States, it's almost the exact opposite, where you have expensive stocks really beating cheap stocks, or another way to say that value isn't working. We run a multi-factor model in Europe called the European BMVP model. And that's up about 27% this year. That uses momentum, value, low volatility, and profitability. So value and factors generally are really rocking in Europe.
So let's connect the two. How does the U.S. value group differ or compare with the European value group?
Yeah, this is something we always look at, right? Because you have factor portfolios, but then you want to see, what are their attributes? What are they like other than the direct factor that we're forming on? So certainly value stocks in Europe and America are obviously cheap. That's what value is. But the value stocks in Europe are much more momentum. They have, they load positively on momentum because they've worked much better than the United States. And I would say both the United States and Europe, it's kind of like anti-growth, anti-profitability of these value portfolios, but Europe even more. So very anti-profitability, things like low ROE, very anti-growth, things like low EPS growth. That certainly has not stopped the factor from working very well in Europe this year, but it's something to keep in mind.
All right, Chris Cain, really appreciate it. Chris Cain of Bloomberg Intelligence with our Factor Friday. And as August trading wraps up, investors bracing for turbulence in September, historically the weakest month for U.S. stocks. Natalia Kniazhevich has been going through the numbers and has more. So Natalia, what does seasonality tell us specifically about September? What do the numbers show?
Yeah, so the numbers show that September is the worst month for U.S. stocks. Data going back to 1950 show that the S&P 500 is typically down by 0.7%. Data going back to 1927 show that 56% of times in September we saw declines, and declines are by about 1.17%. More importantly, when there's the first year of the U.S. presidential cycle, declines are even bigger. So we could potentially expect something around 1.6%.
And Natalia, last year we were in the green for the S&P 500, but really sharp losses the 4 years before that. Why? Why is September so weak?
So we have to keep in mind that there are some factors that are typical for every September and then the current setup. So, for example, we know that pension funds, mutual funds, they typically rebalance their portfolios ahead of the year end, fiscal year end. They sell losers. They also have to rebalance across all asset classes. Also, retail traders, so they typically buy in June, July, but then they slow down a little bit in August and September. Now I'm citing data from Citadel Securities. So potentially everyone is already on vacation. So this is also important. And finally, buybacks. We know that ahead of the next earnings cycle, the so-called blackout period starts in mid-September. And we know that buybacks are really huge this year versus historical levels, right? So they're going to pause in around mid-September. So we won't have this demand from U.S. corporations.
Right. That's a key point, because they've been a consistent source of demand in this equity market. So put that all together with what current positioning might show. How are institutional investors positioning right now?
Yeah, so we also should keep in mind that, as Chris just mentioned, we saw a crash in volatility, right? The VIX is low. When that happens, other types of institutional investors, such as so-called systematic funds, right? CTS, vol controls, they buy stocks when volatility declines, and this is what's been happening now. And when we look at positioning across all these systematic funds, they are pretty full. So it means that there is no more room for buying, and in case we see a downside move, they were going to be forced to sell. And when they do it, we really feel it, because they do it very quickly.
Yeah, we're talking about an S&P down today 0.6%, NASDAQ down about 1.1%. Are we already seeing investors positioning for the seasonality weakness?
I think so. We also should keep in mind that the options market is also signaling that some people are positioning for potential losses ahead. So bear with me. So there's a really good indicator. It's called 10 delta put versus 40 delta put. Basically, this is protection against steep declines versus shallow declines. So it hit the highest level this year. It means that people are expecting some volatility, losses in September, October. And keep in mind also, if you look at seasonality and data for the VIX index, October and September are 2 months when the VIX typically hits 20. Now it's about 15, 14. So we could see more volatility, and it's not going to be bad just for the stock market, but as Bailey knows, for the IPO market as well.
All right, good stuff. Natalia, really, really appreciate your joining us on the seasonality factor for the month of September. There's some breaking news, surprisingly, for the Friday before Labor Day after the market closes. This is from Spirit Airlines Aviation Holdings. That is the holding company for Spirit Airlines. And they have filed for a voluntary petition for Chapter 11 in New York. So basically, they're preparing a new bankruptcy filing, and they've begun this voluntary restructuring process. Spirit Airlines says that it expects to execute comprehensive restructuring overall, and it expects to be delisted from the New York Stock Exchange, NYSE American Stock Exchange, and it expects to continue to trade in the OTC over the counter through this process.
Yeah, and this is a company, Scarlett, that had tried to merge, tried to sell itself to a competitor. So when you're looking at the fallout that we're dealing with this bankruptcy filing, or preparations for that bankruptcy filing, it's a lot of questions around what's best for the consumer, and really when you look at this restructuring, how that ultimately will end up impacting people who rely on Spirit.
So we'll be all over this, because coming up this hour, we're going to dig deeper into the airlines with Deutsche Bank airline equity research analyst Mike Lindenberg and talk to him about what's going on at Spirit. This is The Close on Bloomberg.
U.S. stocks are retreating from record highs following an inflation report that remains above the Fed's 2% target. Though despite today's losses, the S&P 500 posting its 4th straight monthly advance with expectations intact that the Fed will cut rates twice this year. For more on that, we bring in Jim Bianco, president at Bianco Research, right now joining us. Jim, we saw inflation report coming in hotter than expected, though we did see the consumer hanging in there. What are you expecting as we head into a critical jobs report next week, as well as a closely watched Fed decision next month?
Well, I think the Fed has pretty much communicated that they're going to cut rates at the September meeting for the first time in about 10 months. Now, that I've said that, I would also say I think that this is a soft number. What I mean by that is if next week's payroll report or the September 11th CPI numbers are more than expected, that could basically push this probability back to 50-50. So I don't think the final chapter is written on this rate cut for September, but it's pretty likely that we're going to see one.
What kind of fallout would we see in the market across assets if we do get economic data that makes this, to your point, more of a coin flip than a locked-in decision?
I actually think it would be supportive for the bond market. I'm one that looks at what happened last year, because the Fed at the same September meeting a year ago, after Jay Powell went to Jackson Hole and said that there was problems with the labor market, we have to cut rates, just like he did last week, they cut rates, and long-term interest rates rejected it by going up in yield. And I think that that's the risk we have now. The 30-year yield is actually higher right now than it was 1 minute before the payroll report on August 1st. So all this talk about the Fed's going to cut rates, saying that they're going to cut rates, the weak payroll report, is not moving long-term yields down. And I think the risk you face is that they're going to go up if the Fed cuts rates and what they perceive as the weakness in the economy does not come to pass. So if they actually threw that into doubt, it might be supportive for the bond market.
So you mentioned the 30-year yield. I'm looking at it right now, 4.92%. And, you know, it's kind of been stuck in a range over the past 3 months. It hasn't gotten to that 5% level we saw in mid-July, which, of course, is the highest going back to, I think, something like, you know, a couple of months, if not longer than that. What breaks us out of that range? I mean, yields can go up, but are they going to get past 5% again?
Well, I think it's going to be one of two things. It's either going to be signs that the economy is really slowing down. We don't really have that right now. If you look at the Atlanta Fed GDP number, it was revised up big today, suggesting that the third quarter is looking like 3.5% growth. Or it's going to be signs that the economy is heating up and that inflation is starting to percolate as well. Remember now, we have core inflation at PCE at 2.9. We have core inflation at CPI at 3.1. I'm old enough to remember a couple of years ago, these would have been completely unacceptable numbers from the Fed. But now they're going to cut rates in the face of those numbers. So if they keep going up, that could actually push yields much higher if the market feels like the Fed's making a mistake again. So it depends on what we get, because right now we're kind of stuck in this range, and it's the end of the summer and nobody really cares. But eventually, when they're coming back after Labor Day in 3 days, and maybe they'll start caring again.
Yeah, well, we'll keep an eye on that one. I'm curious how you think the drama over what's taking place at the Fed, between the president and the Fed as an institution, how that's going to weigh on policymakers as they deliberate over what to do in September and how they set themselves up for the rest of the year into 2026.
Well, I think it's going to weigh a lot on them, and I think it is mattering a lot for the institution. It is going to be highly disruptive, whatever happens with the court ruling with Lisa Cook next week. Either way, either she gets an injunction, she gets to stay, or she doesn't get an injunction and she has to fight this as a non-Fed employee. And I think that we're starting to see that show up with the way that Jay Powell has been reacting to the market and everybody else. I think this is going to have long-term implications for the Fed. I know everybody likes to say it's going to be loss of independence. It doesn't necessarily have to be that. But I do think that the more immediate impact is going to be the role of dissents. The Fed never has any dissents in their voting. I've been one that's argued that this is the biggest weakness that the Fed has, is this group that everybody has to agree with everybody else. And if they if this breaks them of this could be actually a long-term good for the Fed, in addition to all the other risks that they face.
All right, Jim, really appreciate it. Jim Bianco, president at Bianco Research. And a lot of people say maybe it should be more like the Bank of England, where there is a lot of dissension, and it's okay.
It's interesting.
This is The Close on Bloomberg. Spirit Spirit Airlines filing for bankruptcy earlier this hour. The airline also expects to delist from the NYSE American Stock Exchange, but says that flights are still operating normally as we head into one of the busiest travel weekends of the year. Joining us now to discuss is Mike Linenberg, airline equity research analyst at Deutsche Bank. So, Mike, can Spirit get this done on its own, or does it need to team up with someone? Because there are discussions it was having reportedly with Frontier.
Yeah, no, I wouldn't be surprised that if ultimately what comes out of this is the Spirit assets find their way into another carrier or multiple carriers. I mean, we saw them come out of bankruptcy earlier this year. At that point, they were presented as a viable operating plan, and then subsequent to that, they ended up not performing all that well. In fact, just recently, their June quarter results indicated that the plan wasn't really going according to what they had originally laid out. The losses were pretty significant, and so I think the markets weren't surprised. And if you look at just where the bonds have been trading recently and where the stock has been trading, I mean, people were calling for this, and the fact was that it was probably going to happen sometime as we headed into the seasonally weaker shoulder period of September.
Why are low-cost airlines having such a hard time? Because it's not just Spirit. I mean, you've seen some of these low-cost carriers try to work their way up, try to attract a higher premium customer base, Southwest among them as well. No one likes inflation, and there's always a market for lower airfares, so I'm not sure I understand why they can't survive.
You know what? I think the root cause right now is that we just probably have too many of them. If you think about it, if you want to fly to a place like Frankfurt or Sao Paulo or Japan, there are 3 major U.S. airlines and some foreign carriers that can provide that service. But if you want to fly from the Northeast to Florida, you can get there 7 or 8 or 9 different ways. And so there's just too many seats in the market. And I think that what's happening with Spirit, this rationalization, it's a winnowing of the space.
And I'm just looking at the performance, total return over the last 12 months. United up 146%, Delta 50%, and Southwest, I know they're dealing with an activist and reshaping their business, up 17%. Why are we seeing such a sharp divide or sharp outperformance for some of these companies that are even targeting similar consumers as opposed to the low-budget operators?
At the end of the day, it's the earnings that are being discounted in the marketplace. So if we look at a company like United and Delta, they're on track to report, $4.5 billion of pre-tax this year. Southwest is going to be closer to break even.
When we look at Labor Day, a busy time, are we seeing companies that are better positioned to capitalize or, as you mentioned, offer flights that consumers want for a holiday weekend in the summer?
Yeah, no, absolutely. I mean, I think it's a story of bifurcated demand, the classic K-curve. What we have here is that even though Labor Day, we're going to see record volumes, they're going to be up slightly from what they were a year ago, which is actually pretty surprising considering that capacity is going to be down actually a little bit as we head into the weekend. But the fact is you're going to have some airlines that are very profitable and some carriers that are probably not going to perform all as well. I mean, peak periods are when they actually do fairly well, but overall, as we move through the month of September, what you're going to see is that the airlines that are more exposed to the revenue segments that are doing quite well, which right now, that's cargo, that's premium, that's international, that's corporate. It's the carriers that cater to that price-sensitive customer who, as we know, and we've heard from other sectors, that customer is hurting right now. And if that's your primarily customer base, you're not going to be generating good returns. And that's what we're seeing in the numbers right now.
Yeah, you're really being whipped by the forces, the macro forces around you. Where's the opportunity within the airline sector? I think about Alaska Airlines and how it's pushing really hard to expand routes to Asia, for instance, really trying to be a bigger player in that space.
It's great you bring up Alaska because that is one of two what we would characterize as an idiosyncratic investment story because Alaska is in the midst of a merger. So we're not seeing that with any other carrier. And they're also taking over an airline that is in the midst of a turnaround. When they actually bought Hawaiian, it was viewed as extending a lifeline to that company. Hawaiian, absent the Alaska merger, there was talk about, would they ultimately end up in a restructuring? And so we're seeing that company turn around. And so Alaska gets the benefits of both the merger synergies and the turnaround of a very storied franchise.
I will say I flew business class on Alaska. Not quite the experience that I had on
United.
No
full recline.
No full recline. The seats are smaller. There's no TV.
Yeah.
So how is that impacting some of these businesses?
So that you must have flown them on a transcon route. So when they purchased Hawaiian, they did pick up some 787s and some A330s. They do have lie flat seating. I would think that over time, some of those wide bodies are going to find their way into the New York, maybe Seattle market, New York, LA market. I'm not sure where you normally fly down.
It was SFO to JFK. I thought I was flying economy.
Yep, me too.
Give it time. Be patient.
the outrage from Bailey Lipschultz about his business class flight that did not recline. Mike, thank you so much. Really appreciate your joining us.
Thank you.
Mike Linenberg is airline equity research analyst over at Deutsche Bank Securities. And we're going to stay with travel here because domestic travelers might catch a break this Labor Day weekend with flights, hotels, and car rentals actually cheaper this year compared to last year. That's according to data from AAA. And if you pair that with today's data showing consumer spending is still solid, and it's shaping up to be a solid stretch for travel. Our next guest has a key perspective on these trends. We want to bring in now Tara Minson, president of IntelleTravel. It's a platform offering online travel advisory services. So Tara, where are you seeing the demand show up the most in these, I don't quite believe it, but lower airfares compared to last year?
I know. It is really unbelievable, but it's true. We are predicting a record-breaking Labor Day travel weekend to round out what has honestly been the most heavily traveled summers in over a decade. So it is fast becoming the summer Black Friday weekend. Where they're traveling, mainly domestic, right? A lot of the flight data is revealing that travelers are flying to Orlando, New York, Los Angeles, Denver, Atlanta for sightseeing, attractions, and events. We're seeing a big uptick in event travel. So going to a destination domestically, getting those airfare prices that are 6 to 10% cheaper, and perhaps going to a concert, a festival, a Formula One race, NFL, MLB, US Open right here in our backyard, right? And then kind of building a whole itinerary around it. So it's the reason that we purchased a massive ticketing company this year, because travelers just want more experiences on their holidays.
And Bailey, you're flying tomorrow, right?
Flying to Nashville.
Okay, so Bailey's flying tomorrow on Saturday, which kind of strikes me as surprising because I think most people travel like Thursday or Friday, since it's a 3-day weekend. What tends to be the best deals in terms of flying for this short weekend?
So I think he's smart. He's traveling outside of that window, right? So you're more likely to get better prices when you're not traveling within the Friday to Monday, or if it's a holiday on a Monday, a Friday to a Monday night. So take that early morning Tuesday flight and go right to the office, leave Saturday morning and just cram a lot more into the weekend. So I think that's smart. That's a great traveling tip.
I will say I normally badge in at 7:30, so I don't know that I'm going to, fly Tuesday morning because I think I'm going to sleep in Nashville. But when we're talking about some of these areas that people are flying to, the younger generation wanting to maximize into their opportunities, where are you seeing consumers spending, though? Are we seeing the thriftier budget traveler who's Gen Z, who's using AI to find the cheapest ticket possible on a plane? Or are we seeing people embracing the kind of YOLO lifestyle and just going on these trips?
Well, first of all, AI is really great, but it doesn't replace a human. That's the reason why all of our agents are really successful, right? Even a Gen Zer. We are seeing more Gen Zers and the younger generation using travel advisors because they really, truly know that traveler and what they're looking for when they say budget, when they say authentic, when they say culture immersion. So that's why the benefit of using an advisor is really great. But the truth is, it's a little bit of everything. Who we're seeing traveling is everywhere. Yeah. So Gen Zers, this entire workforce, we've all gotten used to working remotely. So you know what? You can actually, work from home in Nashville, Bill, and extend, a few extra days out of it. But we all got used to that. And what they're looking to see is actually just more. So really see more of the destination, not hit those typical tourist locations and destinations that, quite honestly, AI might give you. So it's those more authentic experiences.
Yeah, I'm going to let you talk about me being able to work from Nashville. I will not say that. But when we're talking about flying to maybe off the grid or maybe kind of less, well-known places to travel, how are consumers spending, though? Because, again, we saw economic data saying the consumer's still paying up, but there's a lot of uncertainty about the ability to, pay $150 for a food tour that takes you around a few restaurants.
So we did see a little bit of softening in the market, honestly, when there was inflation concerns, geopolitical concerns. We're not seeing that anymore. I think what we've learned throughout these past few years, honestly, is travel is not something that people now feel that it's an extra, right? They don't need to spend on. So if they're going to a destination, they're going to really immerse themselves. They want to really experience it, and they might tighten the wallet a little less. They'd rather the experience than maybe come home and buy that new flat screen TV that they wanted, right? It's a better experience, and it's memories versus things.
Yes, memories versus things. I like the way you put that. So IntelleTravel, which you head up, is a host travel agency. You have humans helping people figure out their ideal vacation. We know that a lot of people want to get reward points and, maximize their reward points. And the credit card companies like Chase Sapphire, for instance, or Amex are really steering everyone to use their platforms, Chase Travel or Capital One Travel. Are those your competitors, those platforms?
No, so I mean, listen, those reward programs and points have been around for decades, and they won't go away by any means. And if there is a traveler that wants to use their points because they want their business class, airfare completely paid, that's fine. But the truth is again, it's their personal relationship with their advisor to know that they can still help them with the other verticals of their trip, right? So experiencing the tour, knowing that their kids has, maybe some sensory issues, and they won't like certain experiences in tours, but they will like this one, or maybe they already did other tours in other countries, and they want to give them something a little bit of a different experience, a food experience, a history experience. So that's where the advisor comes in. But, advisors are able to use those loyalty points and have the traveler use, reward them, redeem them, and still get a great experience.
All right, Tara, really appreciate your joining us and sharing some of your expertise. Tara Minson is president of IntelleTravel. And, that's a really important thing. If I don't know that Chase Travel can help you book a tour with your kid who has some sensory issues.
No, definitely. And as you mentioned, though, we are seeing such a big push to use those points on the platform. And it's kind of like, all right, what are your margins? Why are you maximizing on me staying on your platform versus trying to find the best deal?
They just want you to stay on that ecosystem for as long as humanly possible. All right, let's take a look at how markets closed on day. We're just going to recap what happened on the day. It doesn't really reflect what happened for the month, but we did finish with losses here, led by big tech. The Nasdaq 100 losing 1.2%. You have yields moving up at the long end of the yield curve, and the dollar little changed on the day. Certainly a lot of people looking ahead to the jobs report next Friday. This is The Close on Bloomberg.
Duty-free no more. De minimis tariff exemptions for packages worth $800 or less are ending today. The Congressional Budget Office estimates the exemption just for goods from China would result in more than $23.5 billion in additional customs revenue and fees over a decade. Bloomberg's Balance of Power co-host Joe Mathieu has more. Joe.
Yeah, the de minimis exemption or loophole, depending on who you're talking to, went away at 12:01 a.m. This just happened this morning. The provision had been in place since the 1930s, and this could mean many fewer packages on people's front steps here. This was actually the second wave, by the way. It began ending back in May with some goods from China and Hong Kong. Today, it took effect for every other country around the world. And as you mentioned, this affects packages worth $800 or less. And this development has already caused a lot of foreign post offices to suspend their shipments to the United States as the new rules are implemented. There's been some confusion here because we're talking pretty big numbers. There were nearly 1.4 billion de minimis shipments last year. That is the equivalent of 4 million a day, according to Customs and Protection. So why are they being imposed now is the question. President Trump says that these exemptions had allowed fentanyl to be smuggled into the U.S. and put American companies at a disadvantage. By the way, de minimis is Latin for too small to matter, which I learned today. Apparently, guys, it matters now.
Thank you for that lesson in Latin, Joe Mathieu. Bloomberg Balance of Power co-host Joe Mathieu. Too small to matter. I'll remember that one. All right. Well, speaking of tariffs, our next guest says that her skincare business, the specialty skincare business that she founded, is in limbo as the removal of this de minimis exemption hits. That brings us to Next Up, where we highlight the entrepreneurs and trendsetters moving the needle in business and the economy. And today, we spotlight Feather and Bone, which makes plant-based cleansers and balms with a focus on simple, natural ingredients and sustainability. I'm joined live in studio by Feather and Bone CEO and founder Shubhangini Prakash. Shubhangini, thank you so much for joining us.
Thank you for having me.
Your situation is that you do manufacture your products in the U.S., but you do need to import some key ingredients, right?
So as you mentioned, we are no water 3-ingredient products. So this means all of our product is 100% ingredient. We're all plant-based, all botanicals, and a lot of these are not grown in the U.S. So some ingredients like jojoba might, but you have a lot of other ingredients like turmeric, which is key to India, arganoi, which is called Morocco, and these are all imported into the country.
So what has your last couple of months been like? I mean, have you had to find alternative suppliers?
Definitely have to expand that supplier base, but what I've learned from the suppliers is that they have stocked up through this year. So I think that's been sort of a bit of a saving grace. It's going to be interesting to see what happens next year. The question becomes, do they raise the weight the raise in terms of how they do the price rises? And if a country is 50%, do they go 50% for that ingredient, or they just do a weighted average? So that's the piece that we don't know yet.
Well, you talk about pulling forward orders. Were you able, as a small business owner, to, when Donald Trump announced these tariffs in April, at least kind of ramp up and get your hands on as much as you could?
Definitely. We definitely did that. We brought in a ton of packaging. With ingredients, there is, unfortunately, an expiration date. So we could only sort of buy so much. But with packaging, yeah, we did.
Yeah, and when you look at kind of the operation as a small business owner, margins typically are very small. It's a very competitive, tough business.
Yeah.
How does this uncertainty impact your ability to try to forecast how long you can keep the lights on, what 25 and even 26 look like?
Yeah, I think on the cash flow side is where the difficulty becomes. We've definitely thought of solutions to continue to make that cash flow stay strong as possible. So whether that means evolving what free shipping looks like, whether that moves packaging, so we do mostly aluminium-based packaging, whether we switch to a more circular economy type of thing where it's like a deposit, kind of like how milk bottles used to be. So you get your package back. And so we are sort of thinking outside of the box to deal with that cash flow.
Yeah, a lot of unanswerable questions here that you'll have, that force you to be very nimble. What about pricing? How are you thinking about pricing and whether you have the room, the cushion to raise prices on your customers?
Yeah, unfortunately, I don't think increasing prices is an option for us. We're in skincare. It's a hyper-competitive market. So if we increase our price even $5, it seems like a big amount as a percentage, given what's in the environment. It actually is quite small, but that is a massive change. So we're looking at alternatives to keeping demand, as is one of the reasons I started this company was because I believed in accessibility to skincare. And so making sure people have access to good quality. So increasing prices for me is a last resort, which is why we're thinking outside of the box, like circular economy, changing shipping, expanding our sales to international even.
And how's that going right now in this current environment where perhaps customers outside the U.S. may not be too excited about the prospect of buying U.S. products?
Well, it's definitely an interesting one. We're in the early stages. I think when we expand internationally, it would be a full international operation. It wouldn't be something where the products are manufactured in the U.S.
But you're a U.S. brand, right?
Well, we are a U.S. brand, so we would retain that. But then we would have sort of a second office, if you may, and do it that way.
And one thing I always find interesting with small business owners like yourself, so I'm on your website, free shipping on orders over $50.
Yeah.
At what point does that number have to get closer to 75 or 100 for you to be better protected?
That's the question that we're trying to answer right now. It may be where we have to just completely eliminate it. Unfortunately, because the laws are moving, because it's such a moving target, that's the part that, it's hard to predict. It may be something, and that has a little bit more movement, where you can change that lever probably in a more sort of reactive way, so to speak, but not for long. So it is something that we're considering that, again, we don't know.
Well, one thing that I find interesting, your face wash cleanser is tablets.
Yes.
Does that help in terms of shipping? Is it lighter?
Oh, yeah, absolutely.
Okay.
Yeah, we are 100% water. So most traditional skincare companies do between 70 and 90% water. We are 100% waterless. So that makes a huge difference. We're also much more sustainable. So, as why there are cons to the de minimis, there also hope is also, Space NK, it's a very popular retailer in the UK. They are no longer shipping product to the US. So the hope would be that potentially we are getting some of that clean demand for European products. So we'll have to wait and see.
Shubhangini, thank you so much for joining us. She is the founder and CEO of Feather & Bone, a plant-based skincare line. Still ahead, what investors need to watch for over the coming week. From New York, this is Bloomberg.
There is a lot of noise going on, and I think it's most unfortunate because there is already enough uncertainty that's coming at the decision they have to make relative to the performance of the economy. This is a time as the economy is showing shifts, whether it's from policy, whether it's from cyclical factors, that you really want the committee to be able to focus on the debates they will be having at their meeting in September.
And that was former Kansas City Fed President Esther George speaking with us earlier, airing her concerns around the Trump-Cook situation. And that was in our last hour of the close. She says, of course, she wants the Fed to be able to focus amid all this uncertainty. And there's a lot of uncertainty. There's data that sometimes feels conflicting. There's the ongoing tension between the president and the Federal Reserve as an institution, and then you have just people trying to parse through what they expect the impact from these tariffs and other measures that the president is taking will be on the economy going forward.
And the interesting thing has been people talking about the need for a cut next month is like, okay, yes, the economy's in a good state now, but we think the Fed should get ahead of the curve, and we still haven't seen that really showing up. And obviously, when you look at inflation data, it's still well above 2%. So if you want to keep that dual mandate and keep a focus on 2%, it's hard to kind of walk both ways.
So you kind of wonder whether the 2% target is going to go away. Does it become 2-ish? I mean, it's kind of unofficially 2-ish, but no one has said that in as many words.
Now, mixed messaging, it feels like at best.
Well, I mean, it's hard to work through this fog, and so that is why the FOMC has a lot to put on its plate in terms of figuring out how to proceed. All right. Clearly, a lot of that debate will continue, but we're going to take a look at what else is coming up over the coming week. Monday, of course, is a public holiday for the U.S., so no market action there. But Tuesday, Bailey, Congress returns to Capitol Hill.
Yeah, a big focus on what's going on with D.C. and obviously Congress, how things are going to play out now that they're back in session after their summer break. I don't know why we don't get a summer break.
Yeah, well, we're not elected officials. The Fed's Beige Book is due out at 2 p.m. Eastern on Wednesday, and there's still some earnings.
Earnings season carries on. Really an interesting mix. You've got Salesforce, so you're going to get a read on the data on technology companies, but also consumer with Dollar Tree, Macy's, how kind of that K divide is playing out.
And more earnings on Thursday from Broadcom and Lululemon, and the NFL season kicks off.
I think that's more important, arguably.
Dallas Cowboys at Philadelphia Eagles, and finally on Friday, Payrolls. The August payrolls report at 8:30 a.m. Eastern Time. That does it for us. Balance of Power is up next. Have a great weekend, everyone. This is Bloomberg.